Thanks a lot, Marissa. Appreciate you. I'm glad I let you do the hosting. Lets me breathe now.
Yeah.
Um, okay, I want to welcome everyone to the 1031 Exchange All Things 1031 webinar. My name is Hector Perez. I am a real estate agent with Better Homes and Gardens, licensed in New Jersey and in Pennsylvania. Also building social media content at Better Homes with Hector Perez. So Spanish content. So a lot of material. I like to have some Spanish subtitles. So check it out if you guys are interested. So I want to jump right into it. I don't want to delay. I want to get exactly to the start of the show. Marissa with 1031 Corp. She's going to be giving all the details. I just want to warm you guys up. So reasons why 1031, benefits of the 1031 exchange. First, let's start off with who we should be working with. We're going to be working with title. We're going to be working with a real estate agent, a realtor. We're going to be working with a lender because we're going to buy another property and an exchange specialist. Each one is going to be playing a crucial role in this transaction. Now let's get to the benefits. Tax deferral. So we're going to sell a property, a rental investment property, and normally there would be some taxes that we would have to pay on those gains of that property. 1031 is designed to sell a property and then purchase another property. Usually it would be an upgrade. Take all those funds and transfer it over to an upgraded property. Okay. Leverage to acquire a more valuable property to increase some cash flow. And another idea could be to consolidate. This is probably my favorite benefit of the exchange and something that I would promote and speak well about. Consolidation. So you've got 3 or 4 properties, maybe in different towns, maybe in the same town, and you are trying to sell them. Maybe there's a problem with the tenants. Maybe the properties are in different locations. So maybe there could be 3 different problems with these 3 different properties. You can sell all of these properties in one sale, and then you can then purchase an upgraded property. So I like to call it something like Camden and Cherry Hill. You got 3 or 4 properties in Camden, and you're like, man, I can't wait to get rid of this. Some problems with this tenant, problem with that tenant. Maybe it's the location. There's an issue that you just want to get rid of it. Sell all those properties at the same time. And now you could get that dream one investment property out there in Cherry Hill, Camden and Cherry Hill. Want to tell you guys a quick little story. Don't want to take up too much time. My brother-in-law has 3 laundromats in Maryland, Baltimore, Bethesda, Gaithersburg. And I went around with him, driving around, check out properties. He had some maintenance issues and wanted to talk to an employee. He wanted to go to 3 of the locations on the same day. So how many hours is that going to take? He said it's going to take over 2 hours, maybe a little more, maybe 3 hours. And I thought that was really wild. Like, so you have 3 properties, and usually if you're an owner, you want to see the property, you want to check on it, the maintenance, the repairs, employees. Maybe something's going on. Maybe you got to pick up some money. Maybe you got to drop off some money. There's going to be an issue that you got to go to the property. So I think that is one of the bigger issues that you would have to spend hours on that day if you actually had to go to each and every property. So this can be an example of a 1031 exchanges. Sell all these properties because maybe they're just a little bit too far from you and where you actually live right now, and get that one property that's 10, 15 minutes from home. I think that'll ease a lot of your problems, a lot of your troubles. Yeah, there's a repair issue. You have to speak to the tenant employee, and you just go right there and handle it. 10, 15 minutes and you're done. So those are some things to think about, benefits and reasons why. So that's my 2 cents. Up next, City Abstract, Title President Greg Rigo. Better up.
Thank you, Hector. From a title insurance perspective, it's and I don't mean to pass too much of this off on to Marissa at the 1031 exchange company, but there are some nuances from a title perspective of how we treat these files. But for the most part, we're taking direction. You know, we're told and we're advised by whether it's Hector or his clients, if it's a seller that is wanting to move their proceeds into a 1031 exchange company. We are, as a title insurance company, not a designated 1031 exchange uh, holder or vehicle of those proceeds. That would be Marissa and her company and the likes thereof. So what we really do once we hear about that is we have to then designate or be told who that 1031 exchange company is. A lot of times we're asked to refer those companies, so we do. And when we do, we then are directed and work in conjunction with the 1031 exchange licensed company to give us there's assignment paperwork and forms that must be filled out, right? So they're all usually have to be signed by both buyers, sellers, and title, acknowledging that there are 1031 exchange monies being utilized either by the buyer for the purposes of purchasing the property, or that the proceeds are going to go into a 1031 exchange account. Some 1031 exchange companies require that they sign and acknowledge the settlement sheet as well as the assignment papers. Some don't. So, you know, from our perspective, we just check the boxes a lot of the times, Hector, and make sure that that stuff is all properly filled out, properly completed. You know, that again, if it's a seller, that the proceeds make their way obviously to the proper uh, parties in the 1031 exchange company. And you know, if it's a buyer, that we're taking them from the 1031 exchange company to utilize it for the sale. Um, you know, aside from that, there's really not much else. Our software does auto-populate a signature line for the 1031 company on the settlement sheet. But again, sometimes they're utilized and sometimes they're not. Some 1031 exchange companies require that they sign the settlement sheet and others don't. So I think for the most part, for us, it's business as usual. You know, we will get questions as to you know, some accounting questions sometimes as to, you know, what are the proper ways to handle them? What are the benefits? We don't like to answer those questions because we're not accountants, right? We there is some knowledge that we do have. It's general knowledge. But sometimes you can get yourself in a situation where you're giving accounting advice and you're not an accountant. Same thing on the legal side as well. I'm sure John deals with some of that as well. So with that, it's pretty straightforward from our end. We do work in tandem with Marissa and her company, and when we do, it's important to know that the buyers and sellers are in good hands as far as the monies are concerned, for sure. And with that, I guess I'm going to hand it off to John. Is that the
No.
no?
Now, now we've got Marissa, Vice President, 1031 Corp. Star the show. She can lead the way. Um, thank you.
All right.
Nice job, Greg.
Fantastic. Thank you. Thank you, Hector. And thank you, Greg. Yes. And just as a note, City Abstract does make it super easy. They know what they're doing. If it's part of a 1031 exchange, they are on it. Like you said, they click a button, changes everything over, and they're great to work with, super easy. So, you know, it really is a matter of just kind of handing it off, and they're like, yep, all right, it's part of a 1031. So let's jump into 1031 exchanges. Like Hector said, I'm Marissa Locascio, Senior Vice President with 1031 Corp. And we're going to talk about what are 1031 exchanges and how can you benefit from them. So let's start with the basics. What is a 1031 exchange? So Section 1031 of the Internal Revenue Code says that no gain or loss will be recognized as long as you are exchanging real property that's been held for business use or investment. So this is not going to be for your primary residence that you live in, and it's not going to work for properties that you are flipping either. It makes it really impactful to look at an example of an outright sale versus a 1031 exchange. But to really kind of hit home, first, we have to talk about what are all the taxes that you are going to need to consider when you sell an investment property. right? So taxes are going to be due on any gain that you have in a property. If you've owned that property for 12 months or less, you're going to be hit with ordinary income tax on that, which could be as high as 37%. If you've held the asset for a year and a day, that's when you become subject to the long-term capital gains tax rates. And that looks like this. Right, so it's kind of a tiered or bracketed approach. And depending on your adjusted gross income, you could be in a 20% bracket, a 15% bracket, or zero, but that's not likely. If you are selling a property, you're probably going to be bumped up into the 20% bracket. But in addition to tax on the gain, there is also an additional 3.8% net investment income tax, and that's tacked on top of your capital gains tax. And this is a tax that a lot of folks don't know about. So something to kind of take into consideration and see if you might be subject to it. And this is going to apply to things that are considered unearned income, rental income, capital gains, dividends, things like that. So if you're looking at kind of worst case scenario, your gain could potentially be taxed at a 23.8% rate. There is also depreciation recapture. So anytime you own an investment property, you're typically going to depreciate it, right? And that amount of depreciation that you've taken over the time that you've owned this property is going to be taxed at a 25% rate. That's all the federal taxes. We're not done. There's also state taxes, right? So at this point in time, if the state has some sort of income tax regime, it either follows the federal code or they've adopted some version of like-kind exchanges in their state, which means you can defer their state tax, just like you can defer the federal tax. The state of Pennsylvania, if you happen to be located there or own investment properties there, they now recognize 1031 exchanges, but they only started doing so the beginning of last year, right? So we were the last standing state for a very long time that did not recognize 1031 exchanges. So let's take a look at that case study. Now that we know what taxes we're going to owe, we're going to assume we're an individual. We've owned the property for about 10 years. We have an annual salary of $225,000 with $125,000 of additional income from various sources. We bought the property for $350,000, and we haven't really made any significant capital improvements, but we have taken $150,000 in depreciation, and now we're selling that property for $600,000. That means we've got capital gains of $250,000, and with $350,000 of income and $250,000 of gain, we get bumped right up into that highest 20% capital gains tax rate. We are also subject to the 3.8% net investment income tax, and we're likely in the highest income tax bracket, which was that 37% that I mentioned earlier. And the depreciation recapture of $150,000 is going to be hit with that 25% tax. So as an outright sale, it looks like this. So we've got a sale price of $600,000. Our capital gains, even at just a 15% capital gains, which was not the highest bracket, it's $37,500. The state tax, we went sort of middle of the road here with a 5%. The states can range from 0 all the way up to 12. So it depends on where you are, but middle of the road, 5%, that's another $12,500. The 3.8% net investment income tax is another $9,500, and depreciation recapture is $37,500, making that tax liability $97,000. If we take that right off of the sale price, right, and pretend like closing costs and mortgage payoffs don't exist in this example for ease, that leaves us with $503,000. If we use that $503,000 as a 30% down payment for a property, we could buy something for $1.67 million, which is not bad. That's a pretty decent leap from $600,000, right? That gets us closer to a nicer property. However, if we had done the 1031 exchange, we would not owe any taxes. We would be able to utilize the full $600,000 as that 30% down payment and buy a property worth $2 million. Well, that's probably a better property, right? Maybe that property has more units that you can rent, or it's closer to the beach, depending on where you were planning to buy, right? So the most obvious benefit here is you're not paying the $97,000, right? That's goal number one. Don't pay any taxes. So that's the most obvious one, but you're giving yourself the ability to invest all of those proceeds and really leverage that additional cash. You can buy a property that's $330,000 more than if you had to set aside $97,000 to pay taxes at a later date, right? Which means you can probably collect higher rents from day one. If it is, let's say it's a block or two closer to the beach, you can definitely charge more for that, right? That's the name of the game. When you own investment property, you want to make it worth it. So you want to leverage as much as you possibly can. There's also more depreciation available. Whenever you buy for more, that increase in value can be depreciated as a new asset. So that is a good tax benefit on a yearly basis and potentially enjoy greater appreciation long term. So there are other benefits, right? I know the most obvious one is you're not paying the taxes now, but there are some others that I want to touch on quickly that exist with the 1031 exchange. And the first couple of bullet points here are all the things that we just talked about. You're not paying those taxes. You're giving yourself the ability to have the time value of that deferral and keep that money in your pocket working for you rather than shuffling it off to the government, right? And it gives you that greater buying power and potentially increased return on your investment. Again, that's the name of the game. You want to buy something that is going to give you a higher return, more rents, more units to rent, right? It's a more attractive property. Less management responsibilities. There are properties and investments that you can acquire through 1031 that are passive investments. So instead of having to be the landlord and actively manage a property, there are options that do work for 1031 purposes that you do not have to play the landlord role, and you can just collect the income and have that as an option for 1031. Hector had mentioned in the beginning, consolidation. Absolutely. We have had countless investors that sell a portfolio that they've amassed over the years and consolidate it down into one or two properties. And as long as your values work on both sides of the transaction, that certainly is an option. Maybe somebody's thinking of retiring and they'd like to move away from having to manage those multiple properties that are in different locations, take you hours to get to each day. Absolutely a valid point with 1031. More depreciation available. Like I mentioned earlier, when you buy for more, you get more depreciation, which is a great thing. Create new cash flow. Let's just say that what you sold was a piece of vacant land, right? That's not really doing anything for you. Maybe you inherited it years ago and it's just kind of sitting there, but land is inherently considered an investment. And so you could sell that, do the 1031 exchange, and maybe what you buy is a duplex that you now rent out. Well, now you've got cash flow, right? And that is a good thing, as long as you're willing to manage that property, I suppose. Diversification of assets. I always like to share that there can be some misconceptions with 1031 that, if you sold an apartment building, you have to buy another apartment building. And if you sold something that's residential, you have to stay in the residential world. Not true. You can mix and match residential and commercial. You can mix and match the actively managed properties, right? The brick and mortar that you rent out and those passive investments. So it's actually pretty flexible as far as that's concerned. And then for the next couple of bullet points through to the end, I always use a restaurant owner just as a good example to illustrate how you could utilize 1031 and really get some powerful benefits from it. So let's just say we're a restaurant owner. We started a restaurant. We bought the real estate that houses the restaurant, right? Because there has to be the real estate component for 1031. And the business is actually doing really well. However, you've outgrown your space. Maybe you don't have enough seating, business is booming, or maybe you don't have a parking lot that's attached to your restaurant. And it's creating an issue for your customers. So you could consider selling the real estate that houses that restaurant and moving your business to a location that better suits your business needs. Perhaps it's got a parking lot attached to it this time. But if we keep going with that restaurant owner, and maybe they've gotten to the point where they don't want to do the restaurant game anymore, right? The nights, the weekends, it's hard, and they'd like to think about winding down and eventually retiring. So what they could do is, if they're planning ahead, is plan to retire, right, to wherever it might be. Florida, the Carolinas, wherever they're going, whatever the location is that suits them. And they could sell their restaurant, sell that real estate, buy a property in that area that they would eventually like to retire to. And yes, initially they would need to have that property that they acquired through the 1031 as a business use or investment, right? So, they rent it for a period of time. But when they are ready to officially retire, they could convert that property that they acquired through the 1031 to strictly a personal use property, right? There is nothing that says they cannot convert it to strictly personal use. As long as initially it was that business use or investment, it works to do that. And simply converting the use of the property won't trigger any taxes. So that's a good thing. They just simply start reporting it on their tax return as in a different manner. But if we keep going with that restaurant owner, let's say they pass away, what would happen is their heirs would actually receive whatever properties they owned at a step up in basis, which means they would get it at that day's fair market value. So that property that they acquired through the 1031, their heirs would receive it and not be on the hook for any of the taxes, the capital gains, depreciation that restaurant owner had deferred over their lifetime utilizing 1031. Right? So a lot will use 1031 as an estate planning tool and kind of think, how am I going to get my wealth to my heirs without a whole bunch of taxes attached to it? Currently, the estate tax exclusion, right? Because estate taxes, inheritance taxes, those are different than capital gains. So you would need to take those into consideration and consult with an attorney to figure out a plan for that. But the current estate tax exclusion for 2024 is 13.61 million. Right? So they have a little bit to work with. Let's take a look at some of those rules that exist when it's IRS, of course, with 1031 exchanges. This one I mentioned. The term like kind, you may hear 1031 referred to as that. And it is a little bit misleading. It does make it sound like the type of property you sold is the type of property you need to buy, but it really just means that the property must be real property and held for business use or investment. The type of real estate does not matter. Again, you can mix and match residential and commercial. It does have to be in the 50 states, DC, or select territories, but it's a big country, so you have a little bit to work with there. One of the bigger questions that we get is, how long do I actually have to own the property before I can sell it and do the 1031 exchange? And technically, there's no set holding period defined in the regulations. We use as a good rule of thumb 1 to 2 years, 1 to 2 tax returns. But more important than the length of time that you've owned the property is actually your intention when you acquired it. So IRS wants to see, what's the picture you've painted? How have you used the property? How have you reported the property? And has your personal use been minimal? Right? So some things to consider if you are potentially doing a 1031. And a couple of other things to mention just as general 1031 requirements, right? Both the property that you are selling as well as the property you are buying must be held for business use or investment, right? They're not going to work. It's not going to work if you're doing a flip or something like that. And you have to use a qualified intermediary or QI, and that is what 1031 Corp is. IRS does require that you utilize a company like ours to facilitate your 1031, prepare the paperwork, hold the proceeds. One of the big requirements is that the seller cannot touch those sale proceeds, which is why Greg mentioned earlier, they get instructions from us and are making sure they are sending the funds to the correct place, because in a 1031 exchange, it would be a problem if the funds from the sale went directly to the seller. So that's one of the things that we would coordinate with the title company, escrow company, attorney, whoever's doing that closing to make sure that that is clear where they're supposed to go. So Obviously, our role as far as facilitating the 1031, yes, we do the paperwork, we coordinate with the closing agents, but we're also going to make sure that what are all those rules with a 1031 exchange. We'll prepare that documentation, we'll answer your questions, and hopefully anticipate a lot of your questions and make sure you know what's the next step. Right. And so that's our role in the transaction. We make sure that you're feeling comfortable and keep it as simple as possible. There's also time deadlines, right? They give you a certain amount of time to kind of get it all done, right? So there's 2 time deadlines. They're going to start the day you go to closing on your old property, or what we call your relinquished property. So date of closing triggers 2 time deadlines. The first is a 45-day identification period. And within 45 days, you need to give us a written list of what you want to buy to complete the 1031 exchange. From that same date of closing, you have a total of 180 days to actually get it all wrapped up and buy and take legal title to something on that 45-day identification list. One of the other big questions we get, how much do I actually have to buy for to really maximize my tax savings? And the general rule is you want to acquire a property that has equal or greater value and equity. So let's kind of use some numbers to help illustrate that. When you sell a property, let's say you sell for $500,000, they do allow you to subtract off closing costs. So let's just assume you have $50,000 in closing costs, right? So in that scenario, IRS would be looking to see that you bought something for $450,000 or more. And keep in mind, closing costs are things like real estate commission, transfer taxes, the title company charges, items like that. Your mortgage payoff is not a closing cost. So when you sell, of that $450,000, whatever equity you had needs to be reinvested. And if you had a mortgage payoff, the value of that mortgage payoff also needs to be reinvested. And you can certainly go and get another loan to make up that value. Or if you prefer to contribute cash to that purchase to offset the value of the loan, that is an option as well, right? So, when we are talking to prospective clients about a 1031 exchange and they tell us, they're selling for $1 million and they only want to buy for $300,000, that gives us pause because that is a severe trade down, right? That's a big difference. So we want to make sure that it's going to make sense. We always urge everyone to talk to their tax and legal advisor before jumping into a 1031 exchange. But, that one really gives us pause and we go, no. Now you really have to talk to your tax advisor because we want to make sure it's worth it. All right, one of the last big rules with 1031 is called the same taxpayer requirement. Essentially, however you currently hold title to the property you're selling, that's how you need to buy. And so if you're an individual, you buy as an individual. If you're an LLC and you own that property as an LLC, you need to buy as that same LLC. Just one more note on the funds, right? Because that is a big part of what we do. And while yes, we are a 1031 exchange company and we facilitate 1031 exchanges, the more important role for us is to make sure that your funds are secure while they're with us, right? Somebody else is holding your money and that can cause anxiety for sure. We want to make sure that you're as comfortable as possible with someone else holding your money. So anytime we have an exchange, we set up a segregated exchange account for each of those individual exchangers, and it has their name and tax ID attached to it. We use FDIC insured interest-bearing accounts. We also have an option called ICS accounts where it could provide 100% FDIC insurance as opposed to what the standard is, which is currently the $250,000, right? And anytime money needs to come out of those accounts, we require written and signed authorization from our clients, as well as additional internal authorizations from our team. So just a quick note about that. When you are looking at working with a 1031 company, you want to make sure that they're really going to be your partner throughout the exchange and let you know what to expect. Make sure that they're experienced, that they can do the really complex transactions, but they can also walk you through the simple transactions. We have CES designees on staff, which means that we have individuals who have worked in the 1031 industry for at least 3 years, which is the requirement to even sit for that exam. So CES stands for Certified Exchange Specialists. And we are knowledgeable in local real estate and closing practices. And we really do try to keep it as simple as possible. There's a lot of rules with 1031. There's a lot of paperwork, right? No surprise there. It's IRS, but we try to keep it as simple as possible for you. So 1031, it really, really is a great wealth accumulation vehicle. You can build your real estate portfolio using pre-tax dollars. And that gives you the ability to accomplish your short-term goals. Maybe your short-term goals are you're selling this one property, you're going to do one 1031 in your lifetime, you're going to buy a new one, and that's the end of it for you. And that's okay. But maybe you have longer term investment objectives, and your goal is to do a couple of 1031s to get yourself to that, whatever that dream investment is for you. So the more you know, the more you really will benefit. And we are always happy to make a 1031 work for you. All right. That is my piece.
Excellent job, Marissa. So much detail. It's definitely not simple. It's really complex, but terrific job. Greatly appreciate what you did.
Sure.
So gonna send it over to the cleanup batter, VP of Lending, Guaranteed Rate, John Soto. Take it away.
Thank you. Appreciate that, Marissa. Wow, that was an awesome job. Tough to follow. Can you see my screen? Yeah,
Yes.
the PowerPoint? Okay, awesome.
Yep.
So I'm with Guaranteed Rate. I'm a mortgage lender. I've been in real estate for a couple years now. Recently did a 1031 myself, and Marissa just described a lot of the stuff that I didn't even know. So great job, Marissa. Thank you for sharing all that knowledge. So there are many products that you can actually utilize when you're going for the mortgage. So as Marissa mentioned, you have to purchase at or above, and if you don't have all those proceeds, you will need to get a mortgage. So when it comes to the mortgage, my go-to for investors is your DSCR loan. DSCR loan is a mortgage loan for residential income producing property, can also be commercial as well, depending on the amount of units. It is a primary based on debt service coverage ratio or the cash flow of the property rather than the borrower's income. So what does that really entail? So basically the property has to sustain itself. So if the rental income receiving right now is 5,000, the mortgage has to be 5,000 or less. So that's one of the options for DSCR loans. The benefits of it, you don't have to use your pay stubs. There's no verification of employment needed. You can get loans up to 2 million. You can go even higher depending on the amount of units. Depending on that, the loan to value usually around 80%. So you have to put 20% down, and that can come from the 1031. For the refinance option, that's after you purchase, we can usually go up to 75 loan to value. These are for non-owner occupied, so an investment. When you do a 1031, it has to be for investment purposes. Right here, we have 1 through 4 units, but we can definitely go higher from the commercial side. There are minimum credit score requirements, but don't let that scare you. If you have a below 600, it's possible. It's just the rate will be impacted, and usually they require at least 6 months of reserves. So there's also an option for interest-only DSCR loan. And how does that work? An interest-only DSCR loan is a type of loan where the borrower is only required to make interest payments for a specific period, typically at the beginning of the loan term. The interest-only period is predetermined and agreed upon between the borrower and the lender, myself, the company. Common durations for interest loan only period range from a few months to several years. So if the property you're buying isn't cash flowing as much and may not qualify for a DSCR loan, it's good to go for the interest only, and then you can stabilize the actual rents and you can refinance later down the road once the rents go up. So what are the pros of the interest only? Of course, higher cash flow. By paying on interest only, investors will have an increase in short-term cash flow, greater financial flexibility. The reduced payment obligations during interest-only period offer greater financial flexibility. Some other pros are easier entry for investors. So for the interest only, it can make it easier for investors like yourself to enter the market, especially when purchasing income generating properties. Potential for higher returns. You can use additional capital from lower monthly payments to reinvest into other opportunities, potentially leading to higher returns. So you can possibly get more bang for your buck. And then once you stabilize both properties, you can refinance later down the road. Some of the cons, let's talk about the cons, because you know when there's pros, there's always cons. For cons of the interest only, you're not building any equity because you're not paying down the principal. Higher long-term costs, while initial payments are lower during the interest only, you may be left with a higher overall cost over the life of the loan. Monthly payments will increase with the interest only period ends and the loan transitions to a full amortization, including principal and interest. But once that happens and the property is stabilized, we can figure it out to help you refinance if necessary. So who should get these interest-only loans? Investors targeting non-owner occupied residential properties like yourself for the 1031 exchanges, for beneficial for maximizing their returns. Interest-only DSCR loans are also helpful in markets where property values are expected to rise. I don't like betting on appreciation, but if you see something happening very soon, like if they're building new highways, new hospital coming down the road, or maybe like a Tesla power plant or something like that, that's gonna merge people into that area, that can make sense. So for conclusion, interest-only DSCR loans offer both advantages and drawbacks for borrowers. Balancing these factors is crucial for borrowers considering interest-only DSCR loans. And this is my information. I'm John Soder, Guaranteed Rate. This is my email address, phone number, and website. And that's all she wrote. Back to Hector.
John, thanks a lot. I really enjoyed you talking about an interest-only DSCR. Never heard of that. Definitely heard of DSCR, but not interest-only. That's a really interesting option for some people out there.
Definitely.
Trying to increase your cash flow, and then a year or two later. So can it be a year, 2 years that interest only?
Yeah, it can be a year, 2 years. Yeah, we can definitely structure it right to make sure you stabilize the property, keep enough cash. Maybe you got to renovate, you got to do other things. And then once you stabilize, we can get you in a longer term product.
I think I want to do a reel on interest-only DSCR.
Let's right here. That's why we do these webinars.
I think I'd like to do one with you on Instagram Live, interest-only DSCR. That's over the top of a 1031. I never thought of it. I think it's beautiful. If anyone else has anything to say, Greg, Marissa, or any questions, we do have attendee. If there's any questions, now would be a good time, and then we can close.
I'm good from my end.
It was great. Hector, will the questions pop up on the screen if they come through from anyone?
They may. I don't see any.
Yeah, I see a Q&A, but I don't see any.
Nope.
Yeah, we just have one attendee, no questions from, I believe, Kelly. So
Good.
we're good for now. Want to thank everyone for your commitment, coming on time. Marissa for helping out hosting with the slideshow. Greatly appreciated, guys. I'm gonna send the recording out to everyone individually, probably by tomorrow, and I'll also post this on YouTube. I'll send the link of that as well. Thanks a lot, guys. Enjoy the rest of your day. that is all.
Too.
Have a
Thank
good
you.
weekend,
you.
everyone.
You too, guys. Thanks,
Bye-bye.
Marissa.